Hello, everybody. Welcome to Coach's Playbook. I am live from the back porch of my condo, and it is lovely outside. Dan, Hogue, Mick, how you doing?
Great, Jack.
Great.
How are you?
Couldn't be better. I mean, like if this would last for a while longer, it'd be a lot better. But it's gonna get cold again, so enjoy it while it lasts. So today our topic is how to slow down your trading, and we have a lot of thoughts about that actually. But first, Mick, I understand you have a trader shout out for us.
I do. Big shout out today to Yun Chi Wu, up $4,900 trading the NASDAQ today.
Right on. That's a
Outstanding.
pretty
Yeah,
penny for sure.
that's a
So,
good day.
yeah. So, Dan, since you kind of selected the topic for today, I thought maybe you could give us a little rundown of what you mean by slowing down your trading.
Absolutely. So, something I've noticed over my years here at Top Step is a lot of new traders kind of get into this industry and they are implementing very fast trading, looking at very lower time frame charts. Recently, I talked to a new trader who's looking at 10-second charts in the NASDAQ. I don't know how anyone could do that. I feel like I would go crazy trying to watch something move that fast, that rapidly. Obviously, everyone looks at things a little bit differently, but what I've found over the years is a lot of new traders get in and they're looking to trade quickly, be in and out as fast as possible. There's a lot of emotions that get involved. And as they get a little bit more comfortable and the longer they get in this, the more successful traders are slowing things down. They're not executing 100 trades in a day, they're executing 5 or 6. And it's allowing them, if they can slow down what they're looking at, if they can kind of open up some time frames that they're looking at, it's allowing them to see some bigger opportunities. And that's what we want to do here with being discretionary traders is slow down, look for the bigger opportunities. So we're not looking at that little minute, trying to pick up 10 or 15 ticks in something like the NASDAQ. Obviously, every market's going to be, or product's going to be a little different, but looking for that even, that 100 or $50 trades, you want to open up what you're looking at. And I think once you do that, you're going to slow down. You're going to find better opportunity. You're going to be able to manage your risk a little bit more realistically, and the emotions start to come out of it because you're not taking so many trades. You're not going to get caught in that 10, 15 trade losing streak because you're only taking 5 or 6 trades in a day.
Yeah. If I may, I like what Danny said there about looking at different time frames. In regards to slowing down, but well, first I should say, I think most people that have followed us know that I like the higher time frame personally. Top down approach. What are we doing on the weekly, daily, and then go down from there. As far as looking at these shorter time frame charts, like Danny mentioned, 10 seconds. I mean, a lot of time there's nothing. Even though I don't want to do it, I think traders have a better chance at success catching a piece of the trend for the day. And when you're looking at short time frame charts, 10 seconds, you're missing the forest staring at a tree. You don't have a great idea of what is happening in that market when you're looking at it under a microscope. As far as slowing things down, take that top down approach, scan your different time frames of charts. One thing that popped into my mind as Danny was speaking was years ago I was working for someone and I had made mention of a 5-minute bull flag in a certain market. I can't even remember what the market was. And they looked at it, they're like, okay, now look at the 120-minute chart. And it was setting up for a nice bear flag. So I'm caught looking at this 5-minute bull flag that I don't remember whether or not it, would have given anything. But then you look at a 120-minute chart, and it was a beautiful bear flag that ended up playing out. So I got stuck looking at a short time frame, 5-minute bull flag, when the higher time frame, which is in charge, ended up providing an awesome opportunity to make some money to the downside. So that's just something that I was thinking about when Danny was talking.
It's a great example.
Yeah.
Slowing things down is a really good thing. It allows you to instead of being busy active, be busy analyzing and slow your trading down. You're going to make better decisions, especially if you do the planning ahead of time. You can react when the market goes to certain price levels. You know what you're going to do ahead of time instead of acting in the moment, then having a bunch of thoughts run through your mind, and then getting in and out quickly. So
Thanks, Mick. And I think that Hogue and I can elaborate now on just so listeners out there don't think we're just following the, new age psychobabble bullshit, we're going to give you some facts and technical reasons why it's not a great idea to be making hundreds of round trips with the point and click trading platform. So Hogue, you come from a time where once that was the way money was made and careers cemented and legacies perpetuated. Tell us what's different now.
Well, back in the day, if you were standing in the trading pit, you could stand there, 2 bid, 3 offer, and get hit at the same time. You hit at the same time. You can buy 2s, sell 3s at the same time. It's a little bit different now. The queue is true. You're going to be behind other traders on both sides. If you get hit on the 2s, it's going to go 2 offer, 1 bid, and you're basically going to take that loss. In electronic trading, you're in a queue. Trading that short time frame doesn't really work. You're trading against machines that are co-located and faster than you are. Personally, if I look at anything short of a 5-minute chart, it gives me heart palpitations. I can't even do that anymore. And even in the trading pit, there were traders that were longer time frame than just the true scalper buying 1, selling 2s. They can't sell the 2s. They hit somebody on the 1s. It's something that for the discretionary trader doesn't really work anymore. And there's the other thing too. Looking at a short time frame chart, like Mick was saying, you may be looking at what looks like a strong trend on a 1-minute chart that's just a pullback in a bigger move in the opposite direction on a 30-minute chart. You always have to be thinking about what's going on in the longer time frame and the bigger traders. Another thing is, as a performance coach, a lot of traders come to me and say, I just can't stop myself from over trading. I see too many opportunities, and then all of a sudden these opportunities turn into losses, and I'm just constantly being, kind of jerked into the market by these charts that I'm looking at. And I'm saying, well, what chart are you looking at? And if they say the 1 minute, first the heart palpitations begin, and I say that's because you're looking at a time frame that's largely computer controlled. They are what the scalpers were in the trading pit. The machines, the computers are taking that niche now, and we're not going to beat them. So my first suggestion is, if you want to slow down, if you want to trade less, if you don't want to over trade, expand your time frame on your trading, on your charts. 5 minutes to me is still too slow. I'm 30 minutes, maybe a 15-minute, because then I'm not directly watching what the computers are doing. I'm watching what other traders are doing and taking in the bigger picture. Like Mick said, I'm not right up against a tree. I can see more of the forest that way.
What Hogue described, you got to the computerized part of it, but I was thinking when you referred to the traders now, is a generous way to describe an algorithm that is written for the sole purpose of, when you get down to trying to scalp, all that matters is speed and queue position. They're deeply intertwined. Mm-hmm. And it's essentially, like we would say in poker or chess, basically a solved part of the game. A human, you're like John Henry in there. And I guess in the story, John Henry wins, but he also dies. All right.
Yes,
so
right.
just like, I think we play the evidence. I think sometimes people get a little bit confused, because I think we need to bring in the simulated portion of it. Is that I think sometimes people find success using simulators doing some of these strategies, and don't recognize that that's not going to carry over to the live markets, because there's no profit motive for these simulators to build a perfect replica of the markets. They're good enough so that you can practice your strategies, but as far as the exact queue position you'd get when you're scalping, NASDAQ futures or something, they're not giving you a true representation of what you're doing. So if you have your own brokerage account, I hesitate to tell you to give it a try, because you're not going to make money doing it, but I wouldn't take simulator results as validation that this strategy is now going to work when you do it in the live markets. Does anybody disagree?
No, I would agree. And I just kind of wanted to touch on something. Jack and I just did a podcast that's coming out this week that I think kind of goes into this a little bit, even the changes emotionally and psychologically that come into play too. You know, we were talking masters are coming up this week, and he made the comment that, you know, he might be able to go out on Wednesday and shoot a 64, but that's not the real live masters tournament. That's just playing Augusta on a Wednesday. It's when you get into that masters on Thursday, Friday, Saturday, Sunday, to come out and shoot that 64 becomes a lot more difficult. And the same principles apply from the paper to the live, or the sim to the live trading. It completely changes. And when you talk about high execution rates, you know, from a technical standpoint, there are firms out there paying tens of thousands of dollars a month to have faster access to an account or to the exchange. They're also paying to have a higher legal execution rate from the exchange. So there's a lot that they're putting into this to be able to take advantage of that.
Tens of millions.
Tens of millions, yeah.
Yeah, not tens of thousands. And the Masters thing is absolutely right. But I think sometimes we hear people say, like, stress the Masters part. That's psychological. It's a different, you're playing the same course. It would be like if you played the Masters and then the next day was the tournament and they turned every hole into a par 5 that only a machine could drive. So it's not even perfect, because sometimes I feel like people come to us and they say they don't find success using these strategies in a live account, and so they think it's just psychological, but it's more than that. There are technical barriers to these strategies that, and you know what? Prove me wrong if you can. I will be very happy for you if you find success doing these things, but it's unlikely. So I don't know. Does anyone else have something to add? I guess we could go back to sort of like what to look for when you're trading slower, but we kind of covered that.
Well, it's I don't know how, as a discretionary trader, people have the energy to trade that much.
Well,
it's just too involved, too much price action, too much clicking. I'd have biceps
Purple
on my
tunnel.
fingers.
Yeah. I used to find a lot of when I first started trading what I thought were opportunities. So I was fairly active, but you end up learning that you know, these aren't real opportunities. I was scolded early on when I said I'm going to give something a shot, you know, buying or selling one of the grains, and got scolded for saying I'm going to give it a shot. You don't give things shots. You calculate your risk and take an opportunity that you firmly believe in. You don't just throw something at a wall and see if it sticks. I feel like we kind of got off the slowing down trading train and started talking about scalping. I think they're intertwined, you know, scalping, high frequency of trades, you know, on shorter time frames. I like this scalping talk. I know for years we've been talking about, you know, how scalping is very, very difficult, if impossible, to do and be successful with over time, because you're long and short throughout the day. You're trying to predict all the different gyrations during the day. So, and you're looking for small profits while at the same time putting yourself at risk for losses that are far greater than what you're looking for. You know, if I'm trying to scalp and make 3 ticks on a trade, my instant risk could be, you know, in this, you know, a second could be, you know, 10, 20 ticks. You guys know how these markets move. So I don't like scalping. I don't think anybody's going to find success in doing it. So if anybody would like to, I mean, I'd love to elaborate, you know, on that next week and get into scalping more. And talk about why it's a bad strategy. You know, John talked about it. I think there's a lot more we could discuss, you know, regarding, there were a lot of scalpers in the pits that used to do it. You used to see everybody with their hands up in the air, quarter bid at a half. And, you know, what you don't, while the screen is, you know, relatively transparent, it's, orders can get canceled and flashed and all this stuff and revised, where, you know, if in the pit, it was most, you know, traders traded on a shorter time frame, traded on a larger time frame, core positions throughout the day, scalping, you name it. But the one thing that they had that you don't have on the screen is you can see all the guys and girls around you with their hands up bidding. And, you know, if someone, you know, comes in with some sell orders and you see people's, you know, hands go down, they don't want to buy it. Well, you kind of get an idea that, hey, there's not a lot of people supporting these prices. I don't want to be a buyer if, you know, I'm the only one out there trying to buy potentially. So I think we could go into that in depth further if anybody's open to it.
Yeah, I'd be totally down to do that because it was obviously things that worked for a long time, but the market's always changing. And I believe even the high frequency, there's been less of a race now because they've kind of, it's sort of a zero sum game at that level. And it's kind of gotten to the point where even the high frequency algorithms are, to my knowledge, hugely profitable as far as scalping prices at that level. I know that, you know, even 5 years ago when I worked at a pretty heavily funded place with a lot of technological resources and stuff, those trades were already kind of drying up. So if there is, it's a very select few that are kind of owning the market there. A lot of the, you know, big hedge funds that you think about are moving more towards how can we make computer programs that help us do longer term trades using all sorts of crazy stuff. You can read about what Renaissance Technology is doing with all the information that they've collected, or think about what Citadel is doing with the Robinhood stuff. They're working, you know, what they want is more information about the market structure, not just, it's almost become too simplistic to be like bid offer, get it. I mean, just my 2 cents on the issue.
Yeah, I think this industry, it's ever changing. Things are constantly adjusting, and we've got to be willing to adjust with the times. You know, 10 years ago, 15, 20, 30, to sit in the pit and work 2s and 3s, you know, you can rotate it pretty quickly, but then, you know, things change, things are adjusting. And over time, you got to constantly evolve. We went from pit trading to pits and screens, and now it's pretty much just screens. I think there's still, you know, some pits going, but the volume's not totally there. And so everything is mostly screen at this point. And you've got to just be able to transition and adjust with the fly. And, you know, there's some famous videos out there about when screens got implemented and what happened to some of the floor traders that refused to accept. If you didn't accept, you kind of got left in the dust.
Yeah, they were John Henry's, and unfortunately, they didn't even win, and they died.
Yeah, no stories about that. Are you talking about Floored?
Floored.
Yeah, I think the movie's just available on YouTube.
It's on YouTube.
It's free.
Yeah, if you're out there, that's a great to kind of see what we're talking about too. Is Floored's an interesting, it's a good cautionary tale. I'm not sure that it's not to sort of amp up people who are like getting pumped up watching Wolf of Wall Street or something.
It's depressing.
I also disagree with. It is depressing, but
it's a good documentary, but it's a damn depressing film.
Every one of those people in that movie I knew personally, and you can even see me in the background in some of the scenes.
Well, I mean, it's good that it didn't sit you down for interviews. Although you would have probably spruced up the movie a little bit.
Yes, well, I do have a rosy demeanor, I guess.
I remember going to see that the day that it came out in theaters.
Nice. Well, how were they showing it, like the Siskel or something?
I had to go to a different neighborhood to watch it. I think it was only at select theaters, but how got in the car, drove to the theater, sat down, popcorn, cherry Coke, watched it.
Thanks, Mick. It's been so long since I've been in a movie theater. I forgot the process. Thanks.
Yes, me too.
Yeah. Well, on that, yeah, maybe we'll save it for next week. We'll talk more about scalping, and maybe we'll find some sources that say that we're wrong about certain things, and I'm willing to entertain it, but I just have not seen a ton of evidence to the contrary. So, Dan, do you have any questions or a quote that you'd like to shoot out with us?
Got a lot of comments in here, mostly just conversation going on. So hello to everyone in there. But I do have a quote to sign us out on. I like the idea of slowing down. Summer's around the corner. We want to get out and enjoy some warm weather. We want to enjoy slowing down in our lives as well. So I have a quote from Eckhart Tolle. Realize deeply that the present moment is all you ever have. Make the now the primary focus of your life. So get out and enjoy some sun today, because I don't know about everyone else, but we got rain coming tomorrow.
We do. And yeah, progress is made today, everyone. Tomorrow's just an illusion. Stop putting stuff out and go live. All right. That's all for the Coach's Playbook today. Hogue, do you want to, into Easter spirit, sort of give us our farewell blessing, so to speak?
Of course. Blessings to all you traders. Take your time, slow things down a little bit. It's all about, staying in the process and learning a little bit and moving forward every day. Looking forward to your success. Let's trade well. We'll see you next time.